Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate filings. Today, we're diving into a recent 8K report from Urgent Lie, and let me tell you, this one's a bit of a rescue mission, much like what they do with roadside assistance. It's a story of new loans, tweaked agreements, and issuing shares. It's all about how the company is trying to secure its financial future. First off, the earliest event reported is in late February of 2025. Keep that date in mind as we unravel this financial puzzle. This report signals some pretty significant moves by Urgent Lie to shore up their financial situation. Let's dive into the meat of the filing, starting with Item 1.01 entry into a material definitive agreement. This is where Urgent Lie lays out their new loan arrangement, called the credit agreement. It's a big deal because it shows how the company is restructuring its debt and bringing in new money. On the same day, Urgent Lie entered into this credit agreement with MidCap Funding IV Trust and a group of lenders. Think of this as Urgent Lie getting a new credit card with a limit to use for paying off some old debts, covering expenses, and funding their day-to-day business. This new loan matures or comes due in early 2028, giving Urgent Lie about 3 years to get their finances in order. There's a clause about their existing second lien loan agreement, which we'll get to in a bit. This credit agreement is essentially a revolving credit line, meaning they can borrow money, pay it back, and borrow again, up to a certain limit. The limit is $20 million or the amount allowed by their borrowing base, whichever is less. The interest rate on this revolving credit is term SOFR plus 4.50% per year, with a minimum rate of 1.00%. SOFR is a benchmark interest rate, and adding 4.50% to it determines how much Urgent Lie will pay to borrow the money. There's also a fee for not using the full credit line, a 0.50% fee on the average monthly unused amount. It's like paying a small fee for having the option to borrow more money than they actually need. The credit agreement is guaranteed by Urgent Lie and its borrowing subsidiaries, meaning they're all on the hook for paying it back. It is secured by most of the company's assets, like their equipment and holdings, which means that the lenders can take these assets if Urgent Lie fails to repay the loan. Urgent Lie has the option to pay off the loan early, but there's a prepayment penalty. The penalty decreases over time, starting at 3.0% in the first year and eventually dropping to 0.0% after 2.5 years. The credit agreement also includes some rules called financial covenants that Urgent Lie must follow to protect the lenders. These include maintaining a certain level of cash on hand, called liquidity, and keeping a good ratio of earnings to fixed charges, which is tested if they run into financial trouble. Now let's switch gears to the second lien loan agreement. Urgent Lie made some changes to this existing agreement through what's called the Eighth Amendment. This Eighth Amendment does a few key things. First, it allows Urgent Lie to enter into the new credit agreement we just discussed. Second, it changes the interest rate on the second lien loan. For a while, Urgent Lie can pay the interest by adding it to the loan amount instead of paying it in cash. This is known as payment in kind, and the rate is 16.0% per year. After that, they'll pay interest in cash at a rate of 13.0% per year, provided certain conditions are met. Third, it pushes back the due date of the second lien loan from March of 2025 to July of 2026, giving Urgent Lie more time to repay. Finally, Urgent Lie needs to pay an amendment fee of $2.6 million for these changes. It is the cost of getting the lenders to agree to the new terms. Now let's talk about the purchase agreement. It's all about issuing new shares. Urgent Lie has agreed to issue shares of its stock to investors in exchange for them agreeing to the Eighth Amendment to the second lien loan. These shares are called Eighth Amendment premium shares. The company issued over 1 million shares of common stock. Unless Urgent Lie repays all of the second lien loan before July of 2025, they'll have to issue even more shares to the investors, called the subsequent Eighth Amendment premium shares, which amount to over 1 million shares as well. However, if issuing these shares would give an investor too much ownership, like over 9.9%, they'll get warrants instead of shares. Warrants are like options that allow the investor to buy shares in the future at a fixed price. To wrap up this financial restructuring, Urgent Lie has also entered into a registration rights agreement with the investors. This means Urgent Lie will help the investors sell these new shares by filing a registration statement with the Securities and Exchange Commission. Item 3.02 Unregistered Sales of Equity Securities notes that the sale of these new shares wasn't registered with the SEC. Instead, Urgent Lie is relying on an exemption that allows them to sell to certain qualified investors without registration. Lastly, in Item 8.01 Other Events, Urgent Lie mentions they issued a press release about these transactions. This press release is their way of communicating these changes to the public and investors. This report was signed off on late February of 2025 by Timothy C. Huffmeyer, the Chief Financial Officer. So what's the big picture here? Urgent Lie is working hard to manage its debt and secure new funding. The new credit agreement provides a financial cushion, while the Eighth Amendment to the second lien loan gives them more time to repay. Issuing new shares helps raise capital, but it also dilutes the ownership of existing shareholders. Looking at Urgent Lie, they're in a tough but not uncommon spot for a growing company. They need capital to expand and improve their services, but they're also carrying a significant amount of debt. The moves they've made here, while complex, show that they're actively managing their financial situation. The risk, of course, is whether they can generate enough revenue and profit to repay these loans and avoid further dilution of shareholder value. The company's strengths lie in its innovative platform and partnerships, but its weaknesses include its reliance on debt financing and the competitive landscape of roadside assistance. In conclusion, this 8K report tells a story of Urgent Lie's financial maneuvering. They're buying themselves time and securing new funding, but they also face the challenge of proving their business model can generate sustainable profits. It's a company to watch closely as they navigate these financial waters. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, please give us a like, drop a comment, and subscribe for more insights into the world of corporate filings. See you next time.